Today, we are lacing up and hitting the ground running, analyzing one of the most watched stocks out there. Nike, ticker is NKE, and it's currently trading right around $63.28.
Yep.
And we've got a fascinating analysis report to dig into. It takes a really strong, almost counter-consensus stance.
It does. I mean, they're not just saying it's a solid company. They're arguing the market is just completely mispricing it.
The headline is pretty bold. The report calls NKE a screaming buy right now.
And, the whole thesis really hinges on one single powerful idea. To get why this report is so bullish, you have to start with what a lot of people call the golden rule of investing.
Okay, the golden rule. Let's unpack that.
Yeah.
This is the idea that you should, watch what the insiders are doing, not just what they're saying.
Exactly. I mean, think about it. An executive might sell their stock for any number of reasons, right?
Sure. Buying a house, kids' tuition.
Paying for college, diversifying. Maybe 90% of their net worth is already tied up in the company. So insiders sell for a million different reasons, and most of them aren't negative at all.
But when they buy.
That's the key. They only buy for one reason. They have a genuine, high-conviction belief that the stock price is going up. A lot.
And that's the signal here. The report highlights some really significant insider accumulation. We're talking major purchases by the CEO, other upper management.
All reported in late December of 2025.
Right after a pretty rough patch, too. A lot of volatility after that Q2 earnings report.
And that divergence is the entire story. Wall Street got nervous, the stock drops, but the people who actually run the business start writing personal checks for millions to buy shares.
That is the ultimate signal of confidence, isn't it?
It's a huge signal. Okay, let's unpack this. What does this recent insider buying activity tell us about the company's internal outlook, especially when Wall Street seems so hesitant?
That's the question. This is a massive vote of confidence.
And the timing is key. The buying activity followed that rough patch that saw the stock dip as low as what, $62.55.
So management buying shares at that level, it suggests they believe that $62 to $63 range is the absolute floor.
They're putting their money where their mouth is. Real skin in the game.
So what do they know that the market might be doubting? What operational details are giving them this confidence?
The analysis report really drills down on this. It points to three specific internal signals that this buying activity indicates.
Okay, give us the big three.
First, the supply chain issues, the ones that plagued them for, the last couple of years. They're basically signaling those are now resolved. Done.
So no more port backups, factory closures, all the stuff that was dragging down margin.
Exactly. Management wouldn't be making a big conviction buy if they were still worried about just getting shoes from Vietnam to the U.S.
Okay, that's number one. What's the second driver?
The second is strategic. It's about the wholesale pivot. This is something the market has really been struggling with.
Right. They got really hard on direct-to-consumer DTC for a while.
They did, and it makes sense on paper. You get higher margins because you cut out the middleman like Foot Locker or Dick's.
But in doing that, they kind of made their product harder to find for a lot of people. It created friction.
Exactly. They got the high margins, but they sacrificed volume and reach. This pivot is about bringing that balance back, leveraging those partners again.
And the insider buying suggests that pivot is working faster than the public data shows.
That's the argument, that it's accelerating. They're getting the best of both worlds now, good margins on DTC, and huge volume coming back through wholesale.
That would be a massive unlock for growth. And the third point, I'm guessing it comes back to price.
It does. It's the simplest one. Management just sees the current stock valuation as cheap, period. They know what the recovered earnings for 2026 are going to look like, and they're buying based on that future, not the messy past.
Okay, let's stop talking strategy for a second and look at the actual math, because that leads us right into the financial deep dive. The report calls this a screaming buy, but I mean, anyone just glancing at a stock chart is going to see the current PE, the trailing 12 months, is sitting at 37.11.
Which looks high.
It looks really high for a mature company. So here's where it gets interesting. How does the analysis possibly justify the cheap view with that number?
And that's such a critical question. It's about how you interpret these metrics, especially for a company in transition. That 37.11 PE.
It's backward looking.
Right. It's using the last 12 months of earnings.
And those earnings were suppressed. They were artificially low because of all the supply chain issues we just talked about. So the P over E ratio looks high because the E was temporarily crushed.
So investors are sort of psychologically anchored to last year's bad news?
Precisely. The report argues this is where the pricing disconnect is. The market should be looking forward, valuing the company on its expected normalized earning power. That's the whole valuation reset argument. Okay, so if we stop looking in the rearview mirror, what happens to the PE when we look forward?
It changes the whole story. The forward PE, which uses estimated future earnings, is way lower. It drops to around 28. And as earnings really recover and normalize in 2026, that multiple drops fast. That's what makes the stock look cheap now, measured against that future potential.
So it's a classic valuation reset. But even while we wait for that recovery to happen, is there a downside hedge here, a safety net for investors?
Absolutely. And this is a big part of the bull case, the dividend.
Right, they pay a dividend.
NKE offers a yield of about 2.6%. It's 41 cents a quarter. But what's really fascinating here is the safety of that dividend.
How so?
The analysis highlights their balance sheet. The company was sitting on roughly $7 billion in cash.
$7 billion.
That kind of liquidity means that dividend is incredibly secure. It provides a huge buffer against any market volatility while the stock price, catches up to where management thinks it should be.
So we have internal conviction from the insider buys, and we have financial stability from the dividend and that huge cash pile. The fundamentals look pretty compelling.
Yeah.
But does the chart, does the technical side of things confirm this story? What are the charts telling us?
The technicals and the fundamentals are actually in perfect alignment here. The chart shows that the $63 level isn't just some random number. It's a critical support zone.
So that low of 62.55, it really was a springboard, like the report says.
It was. It put a definitive stop to the downward momentum. And after it bounced off that low, the stock stopped selling off and entered what we call a phase of consolidation.
It's just trading sideways.
Trading sideways in a tight range, yeah. It's confirming that a bottom is in.
And in technical analysis, what does that consolidation period usually signal after a big downtrend?
It's often the precursor to a major reversal. It means the selling pressure is exhausted. Buyers and sellers have found an equilibrium. The stock is, it's sort of gathering energy before the next big move up.
Like coiling a spring.
That's a great way to put it.
Okay, so if we align all this, the technical floor, the fundamental recovery, the insider conviction, what are the specific price targets? What's the payoff here?
The analysis lays out two clear targets. The first is a short-term target.
Okay.
It's driven by that technical setup we just talked about. The stock is expected to make a move called a gap fill.
And for anyone who doesn't live in the world of charts, what's a gap fill?
A gap happens when a stock's price opens way higher or lower than where it closed the day before, leaving a gap on the chart. In this case, the stock needs to move up to close that empty space.
So a quick move up.
A pretty quick move, yeah. The report expects the stock to fill that gap back up to the $68 to $70 range.
That's a solid short-term move. But what about the midterm? The 2026 target seems ambitious.
It is. For the midterm, as those recovered earnings really kick in, the analyst's average target cited in this report is $80.83.
Which is, what, a potential 27% gain from here?
About that, yeah.
That's very aggressive. What are the risks? What could stop that from happening?
The main thing the report cites is execution risk, especially with that wholesale pivot.
So if the partnership with Foot Locker and Dick's doesn't go as planned.
Right. If they don't execute on the sales floor or if inventory builds up too fast, it could push that earnings recovery timeline back. And of course, any big global economic downturn that hits consumer spending would slow the whole thing down.
Okay, that's a necessary dose of reality. But still, the case is strong. Let's quickly review the key takeaways from this report for you, the learner.
Sure.
The whole argument for Nike being a screaming buy really rests on three pillars. The first is improving fundamentals, driven by that earnings recovery and the successful wholesale pivot.
Right. The problems of the past year are seen as temporary, not, structural.
Second pillar, technical stability. We see that with the consolidation above the $63 floor, which is setting up for that short-term gap fill.
And finally, and this is probably the most critical pillar, it's that strong, undeniable vote of confidence from the C-suite insider buying.
The report really captures that divergence between Wall Street's hesitation and management's conviction.
It argues that the fear that's priced into the stock right now is exactly where the opportunity is.
It's a powerful story when the people who know the most are putting their own money on the line. So here's a final provocative thought for you to explore on your own.
Okay.
If that insider buying really does predict short-term strength, and the wholesale pivot is as successful as management believes it will be in 2026, how might that shift impact the entire athletic retail industry? I mean, the Foot Lockers, the Dick's of the world. Will they become like stronger partners or just more dependent channels for Nike's success? Something to mull over.